The Psychology of Money by Morgan Housel is a timeless lesson on wealth, greed, and happiness. The book looks at the way money works in the real world. Financial decisions are rarely driven by the theories of economists and the neat spreadsheets of accountants. Instead, a myriad of factors, from personal history to pride and even envy, shape our decision-making. The results are often surprising and always fascinating. Before we continue, make sure to subscribe to join the Investors Book Club today. What's in it for me? Understand the psychology behind financial decisions. How does the stock market work? When's the best time to buy or dump assets? And how much do you need to save every year to retire by a certain age? These are the kinds of questions that dominate discussions of personal finance. There's often something important left out of the equation, however. This is the human factor. In other words, the relationship between real people and their money. Morgan Housel argues that this factor is key to understanding financial decision-making. If you want to know why people bury themselves in debt or squander fortunes, you don't need to study interest rates. You need to delve into the all-too-human history of envy, greed, and optimism. Everyone has their own experience of the economy and money. The Great Depression, following the 1929 stock market crash, led to a decade of global economic decline. In the United States, the prosperous Roaring Twenties abruptly ended as businesses folded, families lost homes, and savings vanished. Poverty and unemployment soared, eroding optimism about the future. While this narrative is widely known, it overlooks a crucial aspect. John F. Kennedy's surprising revelation about his family's wealth during the Great Depression illustrates this point. Not all Americans suffered equally. Economic backgrounds shape our views on money, risk, and reward, even among equally affluent individuals. For instance, someone raised during high inflation periods will view finances differently than someone in a stable price environment. In essence, our understanding of the world is limited, especially regarding the psychology of money. We often know less than we believe. Personal experience drives financial decision-making. When economists model financial behavior, they often use a simplified concept: rational individuals making self-interested decisions to maximize returns. However, reality is messier. For instance, low-income households in the U.S. spend $411 yearly on lottery tickets, while 40% struggle to find $400 for emergencies, largely consisting of the same low-income households buying lottery tickets. This behavior may not be rational, but isn't illogical either. When living paycheck to paycheck, the lottery offers a slim chance at what wealthier people take for granted. Studies by economists Momendier and Nagel show that personal history determines risk attitudes. For example, experiences with inflation during one's youth influence investment choices later. Similarly, stock market performance during early adulthood impacts lifelong investment decisions. In essence, early life experiences strongly influence financial behaviors, often outweighing real-world evidence later on. The economic concepts we use today are still historical infants. Toy poodles may not resemble their wild ancestors, but they still exhibit deep-rooted instincts. This persistence of wild traits despite 10,000 years of domestication parallels the infancy of economic concepts today. Our struggles with money can be attributed to its relative novelty in history. Currency only emerged around 600 BC, and retirement as we know it is less than 2 generations old. The 401k was introduced in 1978, the Roth IRA in 1998. Hedge funds took off 25 years ago, and index funds are just 50 years old. Even common consumer debt like mortgages and credit cards only became widespread after the GI Bill in 1944. Our financial challenges aren't due to irrationality, but rather our limited experience with these relatively new economic concepts. Luck plays a bigger role in financial successes than you might think. The author once asked Nobel Prize-winning economist Robert Shiller about the role of luck in investing, and Schiller emphasized the challenge of quantifying luck's impact on financial outcomes. Luck has a significant influence on financial success, often underestimated or overestimated by individuals. We tend to attribute our successes to hard work and others' failures to character flaws, disregarding the role of luck. Human psychology leads us to either downplay or exaggerate luck's role. Society's obsession with success further complicates this issue, as it celebrates lucky, second-rate investors while overlooking brilliant investors who faced bad luck. To navigate the complexities of financial decision-making, we must incorporate randomness into our models, even if we can't precisely determine luck's exact role, as Schiller wished. Focusing on broad patterns rather than specific cases can help you make better calls. Bill Gates once said success is a poor teacher because it can make people underestimate the role of luck, leading to overconfidence and eventual failure. To incorporate chance and luck into your financial behavior, avoid fixating on specific individuals, especially outliers like billionaires. For example, John D. Rockefeller's unconventional success in the face of legal challenges seems admirable in hindsight, but if he had failed, we would view him differently. The difference between these outcomes often comes down to luck, making it hard to replicate. Instead, analyze common success patterns as they are more likely to apply to your financial decisions. For instance, studies consistently show that people who control their daily routines are happier at work, offering a practical and broadly applicable insight. Envy can make you reckless. Capitalism excels at generating wealth and envy. Consider a rookie baseball player earning $500,000 a year. Though objectively well off, standing beside a superstar like Mike Trout, who earns $36 million annually, leads to discontent and desire for more. High earners like Trout compare themselves to even wealthier individuals, creating a relentless pursuit of success. This envy isn't morally wrong in capitalist terms, but it poses a practical issue. Envy can lead to recklessness, as exemplified by Rajat Gupta. Despite a $100 million fortune and a successful career, Gupta's envy of billionaires drove him to engage in illegal insider trading, resulting in a hefty prison sentence. The lesson here is that letting envy guide your actions can lead to costly mistakes. It's akin to overeating until you're sick. The potential regret outweighs any gains. In short, avoid becoming another Rajat Gupta. Amassing a fortune is easier than keeping hold of it. Jesse Livermore was a brilliant stock market trader in early 20th century America, amassing a fortune by the age of 30. He made a successful short bet just before the 1929 crash, earning the equivalent of $3 billion. However, he soon lost it all. Building wealth is simpler than maintaining it. Livermore's overconfidence led to repeated large losses, eventually leaving him broke and leading to his tragic death in 1940. Making money involves risk, optimism, and courage, while keeping it requires humility and recognizing the role of luck. Many wealthy individuals face challenges in preserving their fortunes, with around 40% of publicly listed companies losing all their value over time, and the Forbes 400 list experiencing a 20% turnover per decade. To retain wealth, perseverance, and a healthy dose of fear are crucial. Entrepreneurs who succeed in the long run avoid risking everything for potentially large gains, making better decisions as a result. You can be wrong half the time and still make a fortune. Heinz Berggruen developed a passion for modern art after buying a Paul Klee watercolor for $100 in 1940. By the 1990s, he became an incredibly successful art collector, eventually selling his collection to the German government for €100 million.